Got some interesting concepts to talk about today. So let's get straight into it. I'm not going to go through this too slowly, but the stream's all about obviously trading principles. We try and develop certain strategies around those principles, get an understanding, talk a little bit about execution, answer some questions you might have had in the week before. Okay, so we're going to go all about breakout trading today. What's really good about this is if you haven't taken the footprint course, this is one of the free sections of the course that we actually put out there, so you can get a feel for what the course is like. But in essence, this is very much a contextual type strategy, and it's important I mention that because I'm going to go through context with you today. I'm going to explain context in the stream, and it's important to understand that if you understand the context, you'll get a very good understanding as to the type of momentum play you're going to get. Okay. Do note it's very much an aggressive execution. In other words, when there is a breakout, you're going with momentum and you need to be quite aggressive on execution. Okay, so we're also going to talk about a volume profile strategy, which is excess reversals. Okay, I'm going to show you what this excess reversal looks like on the charts and give you an understanding of how excess reversals work in terms of profiles. Okay, so where we are today is we're going to focus predominantly on breakout trading, and the best way to sort of illustrate the variances between breakout trading is to understand what the four sort of segments of a breakout trade is. Now, it's so crucial. Every one of us, traders, doesn't matter, professional, young, amateur, whatever. We're all able to recognize where there's the potential for a break. Okay, we see these on the Twitters, on the social medias, on the forums. People generally are good at identifying where there should be a break. Where traders are pretty weak is in terms of, number one, interpreting what the expectation is around that breakout. Okay, number two, the risk management for that opportunity, and number three, how much opportunity there really is. Okay, and this is where the real sort of hard work is, right? We can all do this. This is pretty easy. You just put a couple of lines, identify key resistance and support or whatever, and that's the easy part. The real hard part, and the real part where you've got to go and do your homework, is in determining the types of expectations, determining the risk management approach, and determining the potential for opportunity. And that's what I'm going to take you through today. Now, the most important thing is that if you can decipher the expectations, in other words, if you can determine what your expectations are, then this is pretty easy. Okay, what do I mean by that? Let's say, for example, we have this breakout of this nice little resistance called R1. Okay, now what we're looking for is we're looking for a stop run. So we've identified that the market's formed some form of a ledge. In other words, it's come up here once, come up here twice, come up here 3 times, 4 times. Okay, this might be on a 30-minute chart or whatever. So it's come up here a number of times, and we've identified that there's the potential for a stop run. Okay, in other words, the more times we test a resistance, the likelihood increases that we're going to just extend upon it. Now note, I didn't say rally through it, trend through it. I said we're going to extend upon it. Okay, so there's a high probability we're going to break this R1 line. What happens thereafter is what the expectation is all about. Okay, now if you've gone and you've had a look at enough, say, 5-minute ledges. So let's say this was a 5-minute ledge. Okay, if you've gone and had a look enough at these 5-minute ledges, you'll very quickly come to recognize, okay, that when you have these 5-minute ledges, there's a very, very strong potential that we're going to pop and potentially reverse. Okay, if I switch that time frame and say, okay, let's go observe that exact same concept, but we do it on a 60-minute, right? You're going to find that the pattern play is very different. In other words, it's likely that we break and then potentially continue. Okay, and that's what it's all about. It's about having an expectation based on the strategy you're trying to execute. Right? No two breakouts are the same. No two breakouts will ever be the same. Right? If you observe breakouts on a 5-minute chart, you can start to determine what the nuances are that'll ultimately give you an understanding as to what you expect to see. Okay. Now, let's go back to that 5-minute example. If we expect to see it pop through and then reverse, well, risk management is pretty straightforward, isn't it? Opportunity is pretty straightforward. Okay. If we know the opportunity is just for a quick stop run, maybe 10, 15 prices, we can simply get out for our profit, take our profit, and we can trail a stop. Okay, so we can very simply say once we enter, we maybe put our stop at entry, once we go on sides, and we simply trail the stop, whatever it may be, whatever your approach is. Okay, now I'm going to show you an example of this so you get a feeling for what this looks like, and the best place to look is in the oil market from yesterday. Okay, so to do this, I'm just going to get a 5-minute chart up, and I'm going to show you what this looks like. All right, so if you were trading oil yesterday, okay, you would have noticed we had a little bit of a ledge. Okay, this ledge had formed over the period of the morning. So it was inside a little bit. Okay, so we could see our little ledge had formed on a 30-minute chart, and we had another little ledge up here. So we had these two little ledges that had formed on a 5-minute chart. Okay, now the important thing to understand is that it's not that ledges are necessarily breakout levels, but they are opportunities to target the break. And we can see that the market came to this ledge area, 60, 62, and took it out quite aggressively. So we got a real ramp through there. Okay, now the important thing is, if we just assume and we take the same breakout rules for 30-minute, 60-minute, daily, whatever it might be, what'll end up happening is we'll get on sides. We've identified this ledge. We go long. We go on sides. But we leave so much money on the table. Okay, sometimes we get hit on a trailing stop, sometimes we take a scratch. And we look at it and we go, oh, it was a good breakout, but, it didn't really work, blah, 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 blah. But we don't really actually take away the key takeaway, which is that not every breakout is the same. Okay, so that was the example from the oil yesterday being the 15th of July. Now, let's go back into our presentation. Okay, so like I said, if you understand the expectation, what I expect to see, then the risk management and the opportunity is pretty easy to decipher. Okay, so where am I going with this? Well, I'm going to show you two different variances of this breakout now. I'm going to show you again from the 15th yesterday, because it was pretty much breakout galore yesterday across multiple markets. So let's go and have a look at what the German Bund looked like. Now this time, I'm actually going to bring it to you on a 15-minute footprint chart. Okay, so what you're looking at here is 15-minute rotations. Now, our key little level we're looking at was the break of the 87s, and I'll show you why just very briefly. Okay, so we spoke about talking about profile excess reversals. So if you go back to the 12th of July, which was the Friday, you'll note that the Bund had a very aggressive excess reversal. Now, an excess reversal is just simply where the market on high volume, high volatility, so we can see large rotations, large TPO rotations, so high volume, high volatility gets rejected in an equal and opposite fashion. Okay, so it's a high volume directional move the one way that then gets immediately rejected and reversed in the opposite direction. Okay, now the reason these happen, okay, again, it all comes down to context. So if we were looking for a breakout on this day on the 11th, remember, when we have extreme closes, and again, guys, I'm not going to go through this too much. This is all dealt with in the market profile course. But when we have extreme closes, okay, the probability is high of an extension, but equally the positioning, the short-term positioning, is extremely aggressive. In other words, there's a lot of shorts that enter on the break of this, which means that once we get back above that price point, all right, they need to scramble. Right, and that's in essence what we got. We got the market looking for that break, looking for that continuation through that 171.50. A lot of shorts in the market, came back up above that 171.50, retested it, and we rotated higher. Now, the reason I have to paint that picture for you is because we had a lot of shorts in the market. So over the last preceding week, we had a very aggressive down move, very aggressive shorts in the market. Right. That's why we're looking at that 171.88, not just for the excess reversal. So excess reversals tend to continue in the direction of the excess reversal, but we also wanted to look for a break above that 171.88 for an unwind, so a continuation of the unwind of anyone that was still short. Okay, now let's look at that breakout. So the first thing is we're looking at this little brown line here, the 87s, 88s, and what we can see is just ahead of that break on the footprint, a substantial amount of absorption. Okay, so we can see the volume pick up, we can see the buying activity pick up, but equally we can see the sellers happily reloading. In other words, someone sat there happy to be selling the market. Now, remember what I said to you about expectations. In other words, if we were looking for a stop run, I said to you, we expect to see a fast money move, right? We take up the ledge, quick move, shouldn't really go off sides. Right? In terms of what we're looking now, in terms of an excess approach, we're looking for a slightly more nuanced breakout. In other words, we're looking for price pressure to sort of accumulate and build over time, and that's what we've got here. Okay, so we can see the sellers entering, they get overrun, price closes above those 88, so we confirm the break. The market then continues higher. Okay, we can see the delta confirming it, and then we continue higher for a third rotation. Now note, sellers step in, negative delta. Okay, so we can see a very crucial little pivot here. 06s, we saw the sellers not just take profit, but also get aggressive and start selling into the bids. Okay, we come back, we test the 88s, we bounce first time, we come back a second time, we bounce a second time, we come back a third time, and the market starts to slowly, note, not aggressively, slowly start to bid up. So the break is confirmed at 88s. We haven't even tested the break. We've left a little bit of a gap between the break point and the low traded, which was 90s, and the market starts to rotate higher. Now, this is where the very interesting price action comes in. Okay, we start to see the market bid up. It comes back to that same pivot point, 172.06. Okay, notice again what happens. Some substantial selling. Okay, so we're seeing a lot of selling, i.e. 1,200. But what does the market do in terms of price? Okay, and that's this green little area. So we see all the selling on high volume, but price is closing higher. And again, all the selling on high volume, but price is closing higher. And again, higher. And again, higher. Okay, so we're seeing a lot of selling taking place, a lot of sellers entering, hitting the bids, but price is moving higher. Now, think for a second in terms of price action. How can the price move higher if there's more selling than buying? And it's very simple. The buyers are reloading the bids aggressively. In other words, they're taking as much selling as they can. And the moment the selling pauses, what do the buyers do? They lift offers. Okay. So in other words, the sellers are selling into the bid, but they're not, they're not providing, or they're not continuously, reloading the offer. They're reloading it higher and higher in prices, and that's what's happening here. We can see substantial amount of volume, very chunky volume. 06s to 9s traded out yesterday. Okay, market moves higher again. Market moves higher on negative delta. Market moves higher on negative delta. Okay, and this is one of the best when it comes to expectations. One of the best types of breakouts you can get is where we've got this type of price action, where we see very aggressive selling, but price is closing high. In other words, there's a divergence between the interaction between buyers and sellers and what prices actually do. Okay, because think about it. If sellers are selling that much into the bid, but price is going higher, that's telling you that the buyers have obviously got more to fill, and they're willing to lift the best offer as well. Okay, and that's why it's a particularly important piece of price action. Okay, and we see that happen as well as obviously one time framing. Note we have the 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 candles of one time framing. Okay, all the way up, lots of negative delta, substantially high volume. Okay, we can see that volume well above the average on the day. All right. And that's key, guys, because that's a different kind of breakout, a little bit slower, but that's what we would call a strong price action breakout. In other words, we get out only when the price action changes, i.e. only when we start to see maybe that one time framing series break, which was around 3:45 yesterday afternoon. Okay, so two very different types. One is a stop run. Okay, one is a 5-minute ledge with a stop run. We have a set of expectations for that. This is a slightly different set of expectations where we had to sit from 9:30 in the morning constantly looking to play with the break. Okay, so it's important to learn to decipher between the two, both very important breaks. Okay, now let's go and have a look at the German bunds today. Okay, simply